Well, I'm not going to teach you financial account because I don't know anything in this subject. So I'm going to call on the professor that's going to take you on the subject because he is the working financial account. If you see financial account, answer fit is the working financial account. So I'm going to introduce to you Professor Dr. Dawes Samson. You're welcome, sir. Thank you, sir.
All right. Good afternoon. All right. Today's class we are going to be looking at financial accounts, and the topic is going to be subsidiary book. If you look at our previous class, we explained the process of financial accounting, starting from the source document to the subsidiary, from the subsidiary to the ledger, from the ledger to trial balance, and from the trial balance then to the final account. But by the way, we have already discussed about ledger and the documentary principle. If you look at our previous class, you see those things there. Now, today's class we are going to look at subsidiary book in details. Now, we are going to look at this. What that is the meaning of subsidiary book. We're also going to look at the advantages, and we are going to look at the types of subsidiary book. Then we're also going to look at the presentation and the format on subsidiary book. Then we're also going to look at the trade discount. Alright, now let's start with the meaning of subsidiary book. When we talk about subsidiary book, a subsidiary book is a book of original entry. Why is it a subsidiary? Why is it a book of original entry? Because it's the first book you prepare. That is the first book you prepare in every transaction. That's the first book you need to prepare in every transaction that takes place from the source document. Because the source document is just like your receipt, that's not the record. So the first book you need to prepare is the subsidiary book. That is why it is called the book of original entry. And it's the transaction that takes place or that is being prepared daily, on a daily basis. Now let's go straight to the advantages of subsidiary book. One of the subsidiary books that it is very easy to explain while preparing the transaction. It's very easy. It shows the details that the explanation of the account that is under. That's one of the advantages of subsidiary book. It shows in detail that the explanation of every transaction. Now, the secondly, it also helps us to prepare a transaction in a single format. When I mean a single format, that is, instead of you preparing a separate account, you can just bring all your sales account and format it in one way. That's in a single book. That is, you don't need to prepare individual account or a separate account. You just bring all the sales account together and you prepare it. Let's look at this for instance now. Let's say it's a sales of goods. 5,000 naira to iron. Then another one that is on credit. Then sales of goods. 7,000 naira to John on credit. Now, if you look at this, if you want to prepare a ledger, you need to prepare a separate account. If you go back to your previous class, you prepare your sales ledger account and you prepare your account separate. You prepare sales and then John. But in terms of subsidiary book, you just prepare irrespective of the name. You prepare both. As far as it is under sales, you prepare both of them inside one book. That is what we are saying. So, and what book is that? Sales day book. So that's what we are saying. So instead of you separating it, you just bring both Ayo and John, you put them inside a one book, then you write it. But if it is ledger, you need to separate it. This is Ayo account, this is John account. So it's not like that under subsidiary book. So it helps us to get the full details of the information and collaborate it or put it in a particular format. That's a single format and very easy to understand. Then it can also be used to detect or correct errors. That is, it prevents you from making errors while you are preparing your subsidiary book. It makes it easy. So you find it difficult to make a mistake while preparing a subsidiary book compared to ledger. Alright. Then let's go straight to the types of subsidiary book we have. These are the types of subsidiary book we have. The first one is sales day book. We have the sales day book. Sorry for that. Now, we have the sales day book. So, we have this is types of subsidiary book. We are looking at the types of subsidiary book. The first one is sales day book. We have the purchase day book. We have purchase return book, and you can also refer it, it can also be called return outward. Return outward. Then we have sales return day book, or you call it return inward. Return inward. We have cash book. Then we have journal proper, or we call it journal. Or you call it journal. Then we have petty cash book. Petty cash book. So these are the types of subsidiary book we have. These are the types of subsidiary book. We have the sales day book, purchase day book, purchase return book or return actual. We have the sales return book or return inward. We have the cash book, we have the journal proper, and the petty cash book. So we are going to look at this one after the other. Now, what do we understand by a sales day book? A sales day book is a book that is used to record every credit sales transaction. It's used to record every credit sales transaction. That is, whenever you make a sales on credit, anytime you make a sales on credit, what book you need to prepare is called the sales day book. That is what you need to do on that sales day book. Before you can now start preparing what we call the debtors or creditors ledger control account. But we are going to look at that later. But the sales day book is a book of account that used to record all the credit sales transaction. That is, any transaction you make on credit will appear on your sales day book. Now, what do we understand by purchase day book? A purchase day book is a book that is used to prepare. Is used to record every credit purchase transaction. Whenever you buy something on credit, for instance, maybe you buy something on credit, you purchase something from the supplier, the people that will supply you some goods, you purchase it, but you did not pay for it. That is, you are getting it on credit. So it appears where at the purchase day book. Now, then we move to the next one. We have the purchase return book. We can also call that as our return outward book. What do we understand by purchase return book or return outward book? It is a book of account that is used to record goods that are being returned. These are goods that are being returned to the suppliers. That is, these are goods used to record goods that are being returned to the suppliers as a result of one reason or the other. What am I saying? Maybe you purchase something on credit, and maybe out of the 20 cartons, maybe 2 or 3 of them is defective. That is, some of it is not complete, or due to 1 or 2 reasons. Maybe the goods you purchase, there are some that is not yours, or maybe instead of it to be like 20, it should be there, it was not up to 20, maybe it is 5 or 10. So what do you have to do? You have to return it back to where you get it, that is to the supplier. So that's what we are referring to purchase return out, that is going out. That's why when you are preparing this, it always appears at the credit side. Why? Because you are returning it back to the manufacturer or to the company or to the supplier. That's what we are saying under return outward book or purchase return. Now, the next one we are going to do is sales return day book, or we call it return inward. That purchase return sales return book or return inward is a book that used to record goods that is being returned by the customers. That's goods being returned by the customer. In this case, that means you are the one selling now, not buying. You sell to the customer, and those things you sold to the customer, maybe there are some of the goods they are not good enough, or there's a kind of damage, or there's a kind of low standard, or the quality of the goods is not good. Or maybe, for instance, now maybe you are selling shoes. Now the person you sold a particular pair of shoes where it has the same leg. That's right. Instead of having right and left, but it has got right. That is right foot alone. So the customer has the right to return it back to you as the person that sold the product to. Now that is returned inward. So they are returning it to you due to 1 or 2 reasons. So that is returned inward. They are returning it back to you as a result of one or two reasons or the other. Now, If the goods is being returned to you, but maybe you are also a wholesaler, maybe you buy from the manufacturer, you are not the one producing the shoe, or the pair of set, or the pair of shoes, or whatever you are selling, and the person returned it to you, you don't keep it in your store or your warehouse. What do? You need to return back to the manufacturing company. That is to the manufacturing company. That is where return outwards comes in. You return it to the company that is producing. The customer return it to you, that's return inward. Why do you return it to the company? That's the return outward to replace whatever you purchased or whatever you buy. Now let's go to the next one. And return inward is always at the debit side because it's coming back to you. The goods is being returned to you. Why return outward is always at the credit side. You are returning it, you are getting it out. That is, you are returning the goods out. Now, then we go straight to the next one, is the cash book. What do you understand by cash book? A cash book is a book that is used to record every cash transaction. If you can remember, the other time we explained that we have two types of transactions: credit transaction and cash transaction. Now, the cash transaction, that is under cash book. So, a cash book is used to record the receipt and payment of goods that is being made immediately. That means you are paying immediately as you receive the product. That is what we refer to cash book. It's a book that is used to record the receipt and payment of goods that is being paid in cash immediately. That's what we refer to cash book. And we now have different types of cash book. We should talk about that later. We have the single column cash book, double column cash book, three column cash book, and basic cash book. Alright, that's by the way. Now let's go to journal proper. What do we mean by journal proper? A journal proper is a book of account or a subsidiary book that is being recorded in a chronological order. That is recording of every transaction on a daily basis. That's what we mean by journal. And why is it called journal? Because every other thing, expenses, income, whatever equipment, assets, all those things will appear under journal. So in this case, it's only for sale. This one only purchase. This one return outward. Why this one is return inward? Then this one is the one you receive in cash when cash is payment. Why this one is general? Why is general? Where we have the real and nominal accounts. That is where we have the expenses, the income, the assets, the debtor, and also another things which we appear here. Then we have the petty cash book. A petty cash book is a book that's used to record every of these minor things, expenses or miscellaneous expenses such as stationery, maybe postage, you buy pen, pencil, for refreshment, you need to wash your car, all those things. Or you send someone an errand, all those things appear under petty cash book. But there must be a cash transaction in that case. Alright, that's by the way. Now let's go straight to presentation of the format of day book. How do we present either sales day book, either purchase day book, either return inward day book, whatever it is, aside from general proper. Now, while presenting that, what are those things are there? The first thing you need to know the date. That's the date. The date when the transaction takes place, you take note of it. Then after the date, then what will be there will be details. Details or particular. What we mean by the details, that is what the person is buying. Maybe it's 20 cartons of biscuits. You write it there. The item the item you are buying or the item you are selling out. That is details. Then what we have there is our folio. That is the page where the transaction is, the page of the ledger. Then another thing that should be there for the standard way, we have the invoice. Alright, we have the invoice. You know, if you take notes, whenever you are making a sales, then you see there is a particular slip. We still explain those source documents that are used. Now, when you make a sales, you know there is a slip that is being given. Then in that slip, you see the invoice. There is a particular number that is always written on that invoice slip. Okay, so that invoice slip should also, that is the number. That's what you put there in case of the slip is being misplaced. So it can be easily be notified and found out so that they can rectify it. Then the next thing there is going to be our amount. That is the initial value. The amount is after the discount has been deducted. We see explain what trade discount is. After the discount has been deducted, maybe for instance now the person is buying a large quantity. Let's assume he's buying 50 cartons of milk. And they give the person a discount because he's buying a large quantity, maybe 2% of it. So they have to deduct the price because he's buying a large quantity, depending on the size. So after you have deducted the trade discounts, then you put the initial value. there. So this is the format of presenting either purchase day book or sales day book or return inward or return outward day book. This is the format, dates, details, or return particulars. This is called the folio. That is the folio, that is the ledger number of the transaction which you recorded. Then the invoice, that's the slip. Because anytime you're making a sale, you need to take an invoice slip, you go there, you present it. To look at the quantity of the items you purchased, then there's a slip number and then the initial value, that is the amount of it. That's by the way. Now let's go straight to the general journal, because I said that it's different from that of the other one, which is the general journal. Now the general journal is a little bit different, but it's also part of subsidiary book. The general journal, the format for general journal is we have the dates, we have the details, we have the folio. Here we are going to have what we call the debit and then credit. This is called the general journal. This is general journal. This is how a general journal looks like. I think we have done something like this in our previous class. We have the date, the details, the folio, the debit and the credit. Debit and the credit. So this is how the general journal looks like. That's debit and credit. But in other ones, they don't have what we call debit and credit. Just post everything. Very easy. Alright. Then let's now look at the trade discount. What do we mean by trade discount? A trade discount is an amount that is being deducted from the goods being supplied. Is the percentage of the rate of deduction based on the total numbers of goods supplied. For instance, let's assume I said date 1st of January 2023, that is sales goods of 50 cartons of milk at 500 naira each, with a trade discount of 2%. That means 2% it has to be deducted. That's the trade discount. That is a gift of that company. That is an allowance of a deduction based on the quantity being supplied or being purchased. Now, how do I treat this? For instance, now, instead of the person to pay 500 naira, no, he's not going to pay 500 naira. So that means there is a 2% deduction. So how do I calculate that? That's the trade discount. Trade discount of 2%. How do I calculate that? So it's going to be 2% is 2 over 100. You know that percentage is over 100. So 2% here is going to be 2 over 100 times the initial value, which is what? 500. 500. So these cancel this. Cancel this. So 2 times 5, 10. So that means that a 10, that is 10 naira is being deducted from the value. So instead of paying 500 naira, it's not going to pay 500 naira. So the actual amount that is going to pay per carton is going to be, that is 500 minus 10. So I'm going to have 490 naira. So instead of he or I to pay 500 naira, he's going to pay 490 naira per carton. He's going to pay 490 naira per carton. Or you can still use this way. You can use another method. This particular method, you can say, okay, 50 times 500, that is 50 times 500. This is another way to solve it, which is we have 25,000 naira. Instead of the person should pay 25,000 naira, no, he's not going to pay 25,000 because they gave that person a 2% trade discount. So I need to divide by discount, that is, I need to deduct the value. So that is 2 over 100 times 25,000. So I'm going to have this will cancel this, this will cancel this. So here I'm going to have 5. This is 50. That is 500 naira is being deducted. That is 500 naira is being deducted. Alright? So now, so the initial value the person is going to pay will now be what? 250,000. Okay? 250,000. So it's going to be what? 250,000. Sorry, 25,000 minus 500. So if you remove 25,000 from 500, I'm going to have 24,500. So this is the initial value the person is going to pay. Or you use this, by the way, that is 490 naira times 50. You will see you are going to get this. You are going to get that. That is 490 naira times 50. Right? Let's confirm. So here we are going to have 45, 5 times 4, 20. Then 20 times 4, 24. So 2450. Yeah. So 24,500. Is either you use this or you use this, you still get the same thing. Alright. If you have any question, you can drop it in our comment section. And if maybe you promise on any angle, we are there to help you. So God bless you.
Thank you, Professor. Alright, this is all we've got for you in this video. We're going to see you in the next class. Make sure you don't want information, send information across. Thank you and God bless you.